Well, thank you all who have joined us. I know we've got a few folks that are still trying to connect into Zoom. Eventually, one day, we'll all have the right technology that doesn't have complications or login issues. But I do want to try to keep us on schedule. And obviously, we are recording today's session. I wanted just to remind a few folks about where we are and how all of this is coming together around this P3 workshop on resilience and flood risk mitigation. I'm proud to have the partnership and collaboration with the Insurance Information Institute, which is today represented by Michelle Leonard. And together, we have launched the Institute in its Resilience Accelerator, which he'll share a little bit in a bit, have launched a Resilience Innovation Hub and a network across the country, but also in collaboration and partnership with ACAIX, who you'll hear from Michael Gardner. We've identified the need for a platform that brings together projects, project management, investors who are all seeking to find ways to enhance and improve the transactions for resilience. And then along the way, we'll begin to discuss the opportunity around a Resilience Innovation Fund. But what I think I will use as a reminder really started well before Hurricane Harvey in Houston, with the four previous floods that seem to always occur around a holiday, and the impacts of what those floods have done in the way of putting strong attention to resources for flood mitigation. So federal, state, county, and municipal dollars, well over 20 billion in the greater Texas marketplace have come together. But at the same time, I think folks in this part of the United States will recognize that that's still not enough to cover all of the mitigation that's required. And that is one of the reasons why we've introduced this discussion around P3s. You all will have the benefit of both the slide decks and the recording that we'll post on YouTube from today. But I just want to set this up a little bit, that we began taking a look 2 years ago at this issue of what we then referred to as public-private partnerships. And it's really evolved to public-private and philanthropic partnerships, because you now have a number of foundations and organizations, including the Nature Conservancy in their Nature Vest program, which is an investment program, seeking to figure out this opportunity for flood and risk mitigation. And one of the issues has always been who pays and who benefits. And I think today and this whole workshop series is intended to help sort that out through some examples of previous models and current models for unique public-private philanthropic partnerships. The other part is that whether it's the U.S. Army Corps of Engineers, a state agency, a local program, are all really trying to identify what are the cost-benefit curves for different interventions and different resources that can be applied to reducing future losses. And obviously you see in this one diagram, and it's an example from Florida, that there are many opportunities to create a cost-benefit analysis. As minimal as you can see, things that can be done on beaches and berms, all the way over to elevations and retrofits. All of this to say is that the options are there and the technology and solutions are there, but who's going to pay and who's going to benefit still is one of the areas that needs some additional piloting and demonstration for folks to be comfortable. So today's agenda brings two really brilliant folks from the insurance and data community to talk about where data analytics modeling can help inform public-private partnerships and frankly set at least some improvement for the transactions and the models that need to, or the transactions and business models that need to be put in place. So you'll be hearing from Dr. Michelle Leonard with the Insurance Information Institute and Lawrence Carter with RMS. And then following their presentation, a little conversation, we like to have these become more conversational. We've asked Michael Gardner, our partner from AKX, to give some of his observations about some of the financing and transaction models, as well as to show a little bit more about the Texas P3 marketplace and the platform. So that's our agenda today. I'm pleased to have you all join us. Michelle, if you'll let me pull your presentation up. As you know, I'm trying to get proficient at how to do this. At the same time, if you want to go ahead and introduce yourself, I'll have your presentation forthwith.
I don't need these. Thank you so much, Richard. I don't need these. This thing, AirPods, whatever they're called. Yes, I'm looking forward to presenting today. Richard asked me to talk about really the role of data analytics in the context of supporting public-private partnerships, PPPs, specifically for risk mitigation. So those of you who know me have seen me discuss these issues in the past, but really today what we're trying to do is to be much more specific in looking at how data can be a driver, a catalyst for that purpose. Richard, would you mind going to the next
Yes, sir.
slide? And by the way, for those of you who don't know the Institute, the Insurance Information Institute, it's kind of, we're the think tank, we're the Brookings of the insurance industry. We've been around for 60 years, and we are a non-partisan, non-lobbying research and communications organization. I've had really the pleasure to be there for 2 years after having been chief economist at a variety of insurance companies and being in private equity myself and a few other things. I also teach at Columbia and NYU AI and economics, which is why, Richard, you just don't have a choice. You have to go with the data, with the statistics I gave you about growth in Texas versus California, and of course in New York. So I'm entirely objective in that regard. So the Institute started an initiative called the Resilience Accelerator, and our goal is to accelerate. It's that simple. Accelerate in two things: preemptive risk mitigation in the context of extreme weather events, and then accelerate the speed of recovery post extreme weather events by using insurance. There's a lot of fantastic initiatives out there when it comes to resilience and some of these related concepts, but we're focusing on what we do best, which is bringing the insurance component to the table. Next. Thank you, sir. So we have been bringing partners together. We, as a member-based organization, represent about 90%, I believe, of the property casualty industry in the United States. We include some of my old firm, for example, Aon, carriers, reinsurers, and brokers, insurance trade associations that we've reached out to as well. So IBHS is one of them. IBHS they're the folks who blow up homes and burn down homes. And then one that's not listed here is our sister organization that blows up cars, which you've seen in advertising. Now, we're much boring compared to that. You know, all I have is statistics. So, you know, I can make jokes with it, which is already quite an accomplishment. We've also been working with nonprofit and foundations. We're very proud of that. And as well as with our regulators and academe. NAIC, the National Association of Insurance Commissioners, has been a huge partner of ours in terms of achieving some of this FEMA and FIP specifically, as well as Wharton, Columbia, NYU, some of the institution I'm part of. Wharton is, we're very proud of having this partnership with them for many years with the Risk Center at the Wharton School at the University of Pennsylvania. Next. Thank you. one of the things that Richard came up with early when I got to know him is his distinction between think tank and do tank. I really like that one. So what we've been trying to do with the accelerator is to be laser focused, kind of like a trader trying to get the signal from the noise, but laser focused on where is it that we can make a difference. We can think, but where is it that we can do in that regard? So there's a few areas that we've identified working with our partners, working with the industry, whereby with regards to public-private partnerships, we really can make a difference. And those include data and ratings. So think of that as datification. So we have tools that we're developing or have developed that have to do with rating system for resilience readiness, focusing largely on the role of insurance in that. There's a term in insurance that we call the protection gap. So if you're not familiar with that, the protection gap is the amount, is the share of risk that we're confronted with that could be insured. Some risks can't, but those are the risks that could be insured and are not. And why is it useful to know those is that we can model that exposure, that uninsured exposure, and look at its impact specifically on the speed of economic recovery. We like to think of ourselves in the industry as first economic responders. The first you need to get safe, and that's the job of fantastic, real first responders that are on the ground risking their lives quite often, hurricanes and wildfires and so forth. But once that's done, the check you can get from your insurance company is really the next thing that you need to be able to start rebuilding. And because we can play a difference in insurance, we can also help share with our insured and community and governments and local officials how to also reduce that risk in a preemptive way. So analytics and so forth. Knowledge sharing, communication. We've been part of this partnership we've had at the III with Richard and his organization in the hub down in Texas has been webinars, educating, sharing, and so forth. We've been very laser focused here again. What we felt was important there was to focus on ready to market technologies. So communicating. So this morning we had a lightning round that was all about what is ready right now to bring to market. We felt that there was a great infrastructure for preemptive risk mitigation tools, for quantification tools, but that they were in either the early stage, a VC stage, let's call it from an investment standpoint, rather than in the private equity where it's ready to go to market. And sometimes you can just do it in the context of a partnership with some of the insurance companies. Engagement, we have the different webinars and so forth in being there on the ground when things are possible. Obviously right now is a bit different. And then something that's critical is technical assistance. We've developed at the III, we've made available scholars. We have what we call non-resident scholars. We have fellows. By the way, the III is going to become part of the institutes with an S, which there were many of them. There were a few institutes founded 60 years ago by the industry, and slowly but surely they came together, and we were the last outpost that was not part of it, and we decided to join forces with them. So now all of us will be back in one family, and we're quite excited about it. But they actually are responsible for some of the certification in the insurance industry. So we'll be able to explore with them, working together with our new colleagues, including inclusion of resilience type insight into certification, CPCA, and so forth, and training. Next. Okay, one of the things that is most important when it comes to fast tracking public-private partnership is to provide both sides with data analytics data. And the analytics that sometimes just the data that is otherwise not available to one side or the other. Let me give you an example. Resilience, floods, hurricanes, NFIP, the National Flood Insurance Program. Fantastic program. I've been told, actually, and I believe that that is the largest single risk insurance program in the world. And that makes a lot of sense given the exposure, but it does what the government does well. It's there as a last resort and so forth. But for many years, all stakeholders, private and public regulators, have been trying to develop a private flood insurance market. So last year, after many years, we've had a change in regulation that's allowing, think of it this way. If you're in a flood zone, you're buying a mortgage, you're going to need to get flood insurance. Right now, until recently, until then, only the NFIP, the state program, the government, federal government program could help. Now, actually, some private insurers will be able to provide flood insurance that will qualify for that mortgage requirement. Well, NFIP didn't have private flood insurance. The private flood carriers don't have as much government data. So 2 years ago, NFIP actually created a fantastic database, made it available. Dr. Elizabeth Ash was actually the driving force behind this with her colleagues, and it's become an incredible source of information. Now, we've committed on the private side to do the same thing. So the question here for, Richard, you're saying, what's an example of driving these partnerships? Well, we need to have a common language. We need to have common definitions. We need to have common data. Once we do that, NFIP can determine where's the best use of its funding, and the private sector can determine where's the best use of us from a market opportunity, but also from a common good, and everyone ends up being better served in that regard. So I think that's a really straightforward example of that. But what you're looking at here in front is actually our effort at the III to bring to folks this element of data. This is more of a consumer media tool, but we've visualized different types of risk, different types of take-up risk. This represents actually the NFIP take-up risk. Take-up risk, with those of you who aren't familiar with the term, means the amount of, if you have 100 households, how many have this type of insurance? In this case, how many have flood insurance? So let's say it's 1%, 2%, 3%, and so forth. Next. I want to be mindful of everyone's time, so I'm assuming that I'm running out of my time, Richard.
Couple more minutes.
Okay, sounds
Doing
good.
great.
Perfect. Perfect. Now, the cost benefits here is one of the things that everyone's been talking about is PPPs and so forth, and preemptive risk mitigation, but specifically on the preemptive risk mitigation side. What we've discovered in our work at the III, and again with Richard, his organization, and many of our carriers, is that, I'm going to use this example. Richard is tired of hearing it, I'm sure, but I'm sitting here north of the city because of the pandemic, small house in the mountains. I have plenty of trees. So a few years ago, I was abroad and trees fell because of a tornado. Well, we don't have tornadoes in New York State much, definitely not in this area. And to have two of them coming in a period of 24 hours was very rare. And now I spent, X amount of money taking trees down. Hate to take trees down. It's also very expensive. So I took some down. Should probably still have taken more, which actually we're going to be doing. But that was a cost that I was assuming that my insurance company didn't ask me to. But my investment in preemptive risk mitigation will help the insurance company. Of course, being a beneficiary of the insurance industry, I'm all happy to do that. The reality is that in many cases, people don't have the resources, people don't have the time, people don't know where to go. So a cost benefit sharing is a place where both carriers and me have common interest in actually engaging in this kind of preemptive risk mitigation. And this is a big example, trees, but it can be much smaller elements, hardening of roofs, or knowing what kind of windows to have, or simply cleaning in a better way. Now, all of this costs a little money. What we're looking at right now is to explore how can carriers, working with regulators and consumers, can look at ways to better share these costs, to better align interests. So once again here, you need the cost benefit. For that to happen, you need the data. You need to be able to make it available. And then you have different examples here of how that can be done. But that's the big element. We need the data. Once we have the data from public and private brought together in a way that uses the same structure, then we can run different risk returns, cost benefit, and so forth. And once all sides, all parties to the table can see what they can get out of it in a very quantified way, that normally fast tracks, or it ends everything. It's like, oh, well, there's nothing there for us. But normally, if you have the right people around the table, what happens is that you're able to accelerate. And I'm going to end with accelerate. Is that my last slide? I have something else. Oh, you gave me even more. Richard helped me put this together because I had several things to do this week, and I did not want to miss this. I'm very grateful for him. These are the different steps of relooking at how to finance. So, but again, you identify, you assess, you prevent, you mitigate, and you adapt. Standard steps of risk management and standard steps of how, but you want to look at this, and if you have the data at each step, you can actually see who is best positioned to allocate those risks, or to take on those risks, to diversify those risks. One of the things that we're looking at is to actually look at the about $2 trillion, I think, of assets under management. It's almost $2 trillion that insurance companies have in the United States, only in the United States, because of we don't make money on premium when it comes down to it. We try to break even. We make money, we generate profits for our shareholders or our members, in the case of mutual insurance companies, for by managing our assets under management in a very conservative way so that we can always pay and we can always be there. But we're also looking at how can we allocate some of this capital in a way that is resilient, for resilience bonds, for example. Green bonds have been very successful. CSR, corporate social responsibility investment, has been very successful. We're thinking, how can we explore in the industries some of these ideas? And where is it that we as the industry would be, given our own cost benefits analysis and goals, can be best placed as opposed to, let's say, a traditional municipal bond or a government participation around the table? Thank you, Richard.
So I think that in kind of as you begin to kind of wrap up, and let me ask a couple of questions and then throw this over to Lawrence. But I think as I've begun to learn more and more about where the insurance sector is looking, the first two, risk mitigation and risk transfer, have somewhat been a part of the historical, I guess, offerings of the industry. What I've learned is more and more of these asset management investment, number 3 and number 4, are relatively not new, but these are opportunities where, for instance, so Prudential has an investment arm that invests a lot in for return on investment of the proceeds of selling lots of policies. But there's also some new investment tools that others like Aon are coming forward with, and then the disaster and recovery support. So can you speak to those two from your perspective? And as I do that, I'm going to, Lawrence, get you set up on your presentation. But Michelle, can you speak to that?
Absolutely. But just before you remove the slides, just want to point out to folks in the audience, the InsurTech, the hardening, and some of those elements. And it's fine. I'm done with the slide if you want to move, Richard. But even some of those risk reduction and risk mitigation components are new. InsurTech is relatively new. It allows us to better understand data. Hardening of homes, roofs, and so forth. The data on that is still not fully developed. I mean, engineers in our sister organization, IBHS, does a lot of that. They're the science behind this. But to link, hardening a roof, $30,000. You need to do it on the neighborhood standpoint, otherwise it doesn't really benefit. Significant investment. Now we know that those materials can delay, let's say, by an hour, by 2 hours, by 3 hours, or protect up to a certain temperature and so forth. We haven't done the full work yet in terms of the datification. What does that mean for claims and for losses? So they're still, even there, Richard, there's still some area that we need to step in, and that there are a variety of reasons on that. But and that's going to be key, because as an industry, we have a duty to provide products that are economically viable so that we can pay. That's our most important thing. We need to be able to pay, and it needs to be demonstrable in an actually sound manner. So the affordability and the economically viable component of our products is important. So that's one area there that we need to focus on. And as you say, Richard, the industry has been very good in the past at really thinking big picture thought leadership. But now we're at the point where we need to do the parallel and explore doing same thing at green bonds and CSR type bonds, but doing it for resilience. So projects that are putting a key focus on resilience, and if there are additional costs there, but they're probably going to be better returns, and we can bring the data for that. And I know, Richard, to conclude, that's at the center of what you've been trying to do and very successfully bringing people together.
Thank you. I'm sure we'll come back with a couple of others questions, because I want to talk about some of the gap financing piece of this. Lawrence?
Yes, thanks, Richard, and hi everyone. Good to be here today. Just to introduce myself quickly, my name's Lawrence Carter. I work as a senior consultant in the Capital and Resilience Solutions team at RMS. And my job role has kind of two different halves to it. And on the one side, I'm heavily involved in RMS's effort to quantify new types of catastrophe bond transaction that ultimately get invested in by insurance-linked security firms. And then the other half of my role is applying RMS's catastrophe risk models to non-insurance type risks. So looking at risks to corporate, government, and supranational entities as well.
Wonderful.
And if you could move on, thanks. So yeah, a few things I wanted to talk through today, just to give an overview of RMS, who we are, what we do, a little bit of an introduction to our models, and then we'll start diving into some case studies where we've applied our models to non-insurance type risks. And next. So for those of you who aren't familiar with RMS, we are a risk modeling company founded in 1988 out of Stanford University. And we work with insurers, reinsurers, corporates, governments, and supranational entities to help quantify the levels of catastrophic risk, whether that be earthquake, hurricane, and flood. Or even man-made perils like terrorism and infectious disease. And we quantify those in a way that our clients can make financial decisions off the back of the modeling that we provide, whether that be to price or manage a book of insurance risk, or to make decisions around where and how to mitigate, or where further risk transfer solutions might be needed. And just to give you an idea of the scale of the company, we employ over 250 PhDs in hazard risk engineering and catastrophe risk science, and our clients. Our clients have exposure of over upwards of $1.5 trillion of catastrophic risk that they use our models to help manage. So what goes into an RMS model? This is sort of one way of describing it. Essentially, we take a whole lot of data from a number of different sources, whether that be academic research or government bodies, and we combine it in such a way that we're able to then quantify the risk to insurance companies and other risk holding entities in a way that allows them to make useful decisions. So on here you're seeing a snapshot of the type of data that goes into just one of our models, in this case the US hurricane model. But we have a whole suite of different models. I think there are 9 different models that cover the US, and we have several other models that cover other countries around the globe. So really our data scientists are very proficient at taking a wide array of data and using catastrophe modeling techniques to build stochastic risk models that can help assess risk in a very comprehensive way. And then this is sort of further building out what goes into some of our modeling. So we look at research from academic institutions, a lot of field reconnaissance, particularly post-event. We send out our engineers to go and understand how certain losses have been caused, so that we can incorporate them into future model designs. We also have commercial relationships with a lot of insurance companies who help or who provide claims information to help us build and calibrate our models, as well as remote sensing and satellite imagery, digitized journals and government institutions. And then we employ a number of different scientists and researchers from a wide range of backgrounds to help to convert all of that data into insight for our clients and partners. So one of the things that we've been looking at, particularly over the past few years, is how we can take a lot of this data and science that has previously been applied to the insurance and reinsurance industries, and instead think about how we can use the same information to help public entities or corporate entities to better be able to manage their risk. And so you see on this slide, it's a framework that is pretty much identical to the one that Michelle showed in his deck, where we help our clients to go through these 4 steps and better identify, quantify, mitigate, and transfer their risk to help them ultimately manage their risk in a lot more detailed way than they would otherwise be able to do without the benefit of catastrophe models. And I have an example case study for each one. So Richard, if you move on to the next slide. Thank you. So in this particular case, we were working with a leading commercial real estate company who manage over $2 billion of assets. And we've noticed, particularly over the last couple of years, that a lot of corporate and financial entities are coming to us to try and understand their exposure to climate change risk for the first time, whether that be from additional flood risk from sea level rise, or wildfire risk, or new patterns of precipitation that hadn't previously been identified. Now, the difference that comes with working with a commercial real estate company is they have this long view of risk. In this particular case, they were buying and holding properties for up to a 30-year period. So they wanted to make sure that any of the assets that they were taking on would be adequately protected, or would be a low enough risk from flood that they wouldn't be concerned about mortgage defaults as or loan defaults as a result of major flood events. So we helped identify all of the risks in their portfolio and provided them with screening tools to be able to analyze risk to any new location they would consider underwriting, so that they could ensure that either there was low enough risk or the entity had plans to properly protect itself, either through mitigation or through insurance. And next slide. So moving on to our quantification. So we do a lot of work with public entities to help them think about what the leading risks are to their communities, and then what ultimately they can do to go and reduce that risk. So in this particular case study, we're looking at the risk to Charleston County, South Carolina, from earthquake, hurricane, and storm surge type risks. Where RMS data can be very beneficial is that it allows a truly comparative set of loss metrics across different types of peril. So in this case, between earthquake, hurricane, and storm surge, as well as across different geographies. And so having a data set like such as this for reference is really useful for not only quantifying the size of the risk, but also to help an entity to be able to prioritize which risks it will mitigate, and where it will go and mitigate against them. And this is proved to be a bit of a step up from how emergency management had been conducted at the public sector level, where a lot of the risk professionals were very reliant on historical experience from events rather than a looking forward type approach, and they were also sort of quite reliant on their gut instinct as to where they should think about spending their resilience dollars, compared to using a truly objective and analytical process.
And this also includes the predictive analytics side, right? So it's not just, like you said, focus on historical or current state, but it really is using y'all's capabilities of fairly proven out predictive analytics. Am I saying that right?
Yeah, exactly. So how we build our models is that we not only think about what's happened in the past, we also think about what could happen in the future, and we build models that include many different versions of what the next event to hit the US might look like. So to give you an example, our North Atlantic hurricane model contains about 50,000 different storm tracks, all of which could be the next major event to hit the US coastline. So that will include things from like a category 1 hurricane making landfall in New York, all the way to a Cat 5 making landfall near Houston. And so that, and then when you layer on a probability of occurrence for each one of those storm tracks, you can build up a picture of the probability distribution of experiencing various different loss amounts over an annual or even a multi-annual period. And that's the type of analytics that we've used here to assess the risk to Charleston. So having been able to identify and quantify the risk, the next stage, and probably the most important, is what do we actually do about the risk? And RMS has been involved in a number of projects where we've looked at risk mitigation and being able to value the economic benefits of investing in certain mitigation techniques. So in this particular example that we're sharing on the screen is a study for the city of Berkeley in California, which is located on the Hayward Fault, which could be one of the most devastating fault lines in terms of risk and damage to properties in the Bay Area. The challenge that they gave us is that they had several earthquake shelters in the region where people would go following an earthquake event, and they wanted to assess how well they would themselves stand up to the earthquake risk. And what we found through our analysis was that the earthquake shelters were, on average, more vulnerable than the average buildings in the region to earthquake risk. They were more likely to experience damage, which obviously isn't ideal when they're designated as your shelter facilities. So the next step that we took was to be able to do a cost-benefit analysis for the city, where we looked at the cost of retrofitting some of these structures versus rebuilding them in a different place or using different built materials. And we found through the study that it was much cheaper to go for the retrofit approach. And consequently, the city was able to save money as well as enhancing the resilience of the city.
And I want to reinforce this, that some of the strategies that we've been talking about and increasingly engaging with are not to replace significant amount of infrastructure that needs to be put in place for mitigation, but at the same time, it's a portfolio, that there's a portfolio of options, including less expensive, but just as, if not better, cost benefit on retrofitting. So I think, you one more time reinforced that we, in many places across the country, we need to build the infrastructure that probably has not been built over the 30, 50 years. At the same time, there's a lot of assets in these communities that could be retrofit at a lot less expense, but get the same, if not better, results. And I think this is one more example, although it's earthquake related. I think what we're hearing from you and others is that there are similar opportunities in the flood and storm surge area, if I'm saying that correctly.
Yeah, definitely.
Yep.
And then the final piece of the framework that I wanted to talk to quickly was around for those certain types of risk are not going to be easy or possible in an economic way to mitigate. So for those types of risk, there's always risk transfer as another tool that can be used to help reduce the financial burden of holding on to those risks. And in this particular example, we were working with a large healthcare provider who were thinking about how to structure their risk transfer schemes in order to minimize the costs to themselves of the insurance. So they were looking to evaluate between traditional insurance, setting up a captive, or issuing a catastrophe bond. And so we were able to take their assets that they, the healthcare assets that they own, and run them through our modeling software to be able to quantify the risk to the portfolio of assets. And then using that information, we were able to work out how they should most efficiently go about insuring those assets in such a way to reduce the total premium and help them think about what risks they were comfortable holding on to versus what they wanted to get insured. And Richard, that's everything from me, so happy to take any questions.
Hey, Lawrence, on the last slide, some people may not be familiar with some of those instruments, such as catastrophe bonds, and so it might be worth just a minute to kind of explore those. And I'm being very selfish in the comment because I think it's a great lead into my comments too. Basically, for people just to understand the tie-in of data and modeling to a particular financial instrument that could be used to actually fund the mitigation measure.
Yeah, sure. So, I mean, briefly, I think traditional insurance is what most people know of and think about as being insurance, and it would be the same for very similar for a corporate as a residential policy in a lot of ways. An insurance captive is a type of insurance scheme that's often employed by particularly large corporate entities where they are effectively self-insuring, but they're doing it in a structured way such that they are paying a premium. They're consciously paying a premium on an annual or sub-annual basis into a fund that will sit there and be available for them to draw upon if a large event were to occur. And then a catastrophe bond is in a lot of ways for the insured entity is very similar to insurance, but instead of an insurance company being on the other side holding on to the risk gets transferred to the capital markets, and investors in that risk will receive a coupon payment on a 6-monthly basis to compensate them for holding on to the risk. And then if there were an event large enough to trigger the bond, then the insured entity would receive the principal of that catastrophe bond, and then the end investors would stop receiving their coupon and would lose their initial investment in the principal.
And I think that ties a little bit to a question I wanted to come back, Michelle, to you, because I think my sense is both you and Lawrence kind of circled around this, and that is the gap. And that may be where the public-private partnership model comes to play. And I think I kind of go, Michelle, back, share the amount of, of resilience that can or cannot be insured, right? So to that end, there are hundreds of projects, thousands of projects across the country that are about ready to be financed, some of which may not achieve a level of resilience that could, frankly, reduce the catastrophe that's been identified, Lawrence, by some of y'all's data and research. The other is that there's a lot of great projects out there, but still not enough government public sector financing that have the impact that you want, but just there's not enough resources in the public bonds or legislative appropriations. So what I'm really interested in is where insurance comes into that gap and plays this role. Is it the creation of a catastrophe bond that needs to be brought to market? or what are the other tools? Hopefully I'm making sense, but
Let me, if you want me, Richard, I can start. I think that this is a great opportunity to just clarify a few things. Jefferies, the investment bank, is one of the lead arrangers. I learned that last week. It so happens I've worked with Jefferies in the past, so I'm very excited about that in resilience bonds. So, you know, you need a broker dealer to be able to put the bonds together. Insurance companies don't do that. They may have investments in broker dealers, but they're not broker dealers by law. So they wouldn't issue the bonds. Also, insurance companies, as you and I, Richard, discussed for a while back, you know, there's the insurance side of it, and there's the investment arm, and they're separated for a variety of good reasons, not only just institutional, but also sound management and practices and so forth. So when we go back to this question of when can the insurance world or capital make a difference, I think from all of those perspectives, if it comes to looking at risks that can be better allocated through transfer. And by the way, Lawrence, I love the way you use the word scheme, because it is a British word. And I spent time at Lloyd's when I was with Jardine. And in the US, though, you probably don't want to use insurance scheme, because scheme is bad in the US, but it's a British word. It's like bespoke. I love the word bespoke. Anyhow, back to serious things. We can best optimize the transfer of certain risks. So it may be a project that has a resilient component that otherwise would not, for a variety of risk factors, be done. And we can step in either with a standard P&C policy that is tweaked, or with specialized products. I mean, Lloyd's and so forth, for example, are very good at that. It can be looking at credit insurance and some elements, et cetera. So there's a variety of products, both existing and that can be bespoke, that actually could step in from that perspective. But I think, and a lot can be done there for sure. And brokers actually are key in being able to work as an intermediary between carriers, reinsurers, and insured and their clients on that. I think another area that more and more can be done is the assets under management side. And that's an element where we go in the market, and the investment arms may consider to go in and invest in certain developments that may have a higher cost because they have invested themselves, and they're, you know, it goes back to something that a project you had introduced me to in the Houston area, where the developer, large scale development, urban planning, was investing more in money management, and therefore the financing cost was a bit higher. So was there a place there where in a free marketplace, the bonds for that could be issued, and where carriers, through their investment arms, would be willing to go and actually invest. And then finally, there are products such as, I think, Lawrence, you were talking about, and some of our friends, Richard, that we've talked to in the different companies, carriers and so forth, and brokers can develop, are specifically focused on picking up the resilience component of the risk on an existing bond. So you can have a financial instrument that has that, it almost becomes a derivative like, and I think, Lawrence, you explained it better than me there. So that would be my 5 cents there, but definitely a lot. The bottom line for me when I talk about this is there are great instruments that can be used right now that don't need to be invented and that are underutilized, policies, so forth. And then there are new areas where the industry and broker dealers, for example, Jefferies, can actually work together to channel capital more efficiently into those areas that benefit everyone.
Lawrence, any add
No,
there?
I think that was a pretty good explanation. It's something that we're seeing more and more from entities that we're working with, are looking for how to close that feedback loop between the risk reduction and a reduction in insurance premium. I think it's something that is modelable by RMS, and I think there's potential that more of these types of transactions could have in the future, and it would actually be pretty exciting to explicitly reward innovative mitigation approaches through reduction in insurance premiums going forward.
I'm gonna add to what Lawrence just very well said. And by the way, my apologies for my computer talking. I still haven't learned to find a master button that turns it off when I'm on webinar, so my apologies for that. It will happen. The premium component is one where it's very difficult on the consumer side. It's much easier on the commercial side, where the regulatory burden isn't as high. Not to say it's impossible, but this is where work such as what Lawrence and RMS are doing is very important, to be able to demonstrate an actually sound basis and economically viable from a product standpoint basis, that the pricing, the actual tables can be adjusted in a way that's favorable. But for me, what's as important as pricing, because having been on the brokerage side and working with carriers and underwriters and so forth, what matters quite often isn't just the price, it's the terms and conditions. And those can be done, especially on the commercial side, again, much more easily. I've rarely seen a deal go down in insurance because of premium. You know from the beginning what the premium ballpark will be. It's the terms and conditions that become quite difficult sometimes. And those are areas where, again, Lawrence and RMS's work and other folks in the industry can really make a difference quantifying and making these transactions happen. But I think it's very important for us to think terms and conditions as much as premium, if not even more so.
Right. Michael, I know we've got just a few more minutes left, but some observations and comments about how
thanks.
this feeds into the platform and your thoughts?
Yeah, thanks, Richard. I think I'd like to take the discussion back to the beginning where we were talking about, think tank versus do tank. And I think the question is, how do you take some, these were great presentations kind of overviewing the state of being able to employ models and data and the fact that there are instruments. And as Michel was saying, that they're underutilized today. And, but the question is, well, how do we get them more into play and how do we try to, utilize them more fully? For those of you who don't know, Richard and Akayax have been thinking about this for really quite a while and thinking about how Akayax software can play into this. And we've created, Richard, if you want to screen share or enable me to share my screen, I'll give people a quick.
Yep. Keep on going and I will pull this up.
So we've been thinking for a while about how can you put this into play basically, and the issue is essentially taking Houston. I mean, we're talking about national. We're talking here about kind of national measures and so forth, but just to take Houston and Texas as a I guess my screen is appearing true because I'm getting an error message that I can't show it, but is everyone seeing my screen now?
Well, I pulled it up.
Oh, no, but can you enable me to show, because I want to show people the actual marketplace.
I've pulled up the marketplace. I'll try, keep on going and I'll try to make sure I'm getting the.
Okay, well, if you could, the thing to do, Richard, would be to click through to go to the actual, the actual marketplace site so we can show people projects basically. But I think the question is, how can you organize in a complex social situation across many, many, many different departments and jurisdictions and agencies for them to effectively collaborate to come up with, the right projects that need to be invested? Once you have the right mitigation measures, then you can turn to, the instruments and what's the best way to finance them and so forth. But the first thing you have to do is figure out, well, what are the mitigations? And there are so many different considerations in that. There's just the strict consideration of what's going to enhance, resilience in some sense, flood defense and things like that. But more, additionally important are things like, how many jobs this is going to create, or what's this going to do for the environmental situation. Will this have, a positive environmental impact, or is it going to have a detrimental impact? And so, and this is where we can get into the Akayax software, and that's what Richard is showing basically, which is software that allows the collaboration across any number of different entities that could be, public agencies, they could be nonprofits and NGOs, they could be commercial entities, could be insurance companies, it could be engineering companies, construction contractors, and so forth. And they can all come together. The software allows the collection of projects. And what we're looking at here are just some sample projects, basically. Richard, if you want to open up maybe the first one, Project Braze, any of them really, basically. But these projects are really just, these are all demo projects, to be clear. These aren't real projects, but they're showing how the software can allow projects to come in we have these rating models down below. So where it shows rankings, we have the ability to determine how to rank the projects across a few different considerations, but it's really, really very easy for us to add in additional ratings here. So if you wanted to rate a project specifically on the flood resilience and and so forth, that becomes a very easy thing to do. We also have the ability to integrate data. And so this software is designed to facilitate the collaboration and the collaborative decision-making and analysis using data and using models so that, in a given area, you can actually act and you can say, look, across all these projects, across all these projects, we have been able to bring in, 2,000 different candidate projects, and we've spent 6 months reviewing them and filtering them and sorting down to the 30 or the 50 that we think are the highest impact, or maybe it's 200, whatever that is, basically. But we are, we filtered them down to the projects that we think are going to make the most difference, and now we can go into the mode of, actually getting them funded. And that funding can come from many sources. I mean, in the Houston area, for example, currently there's actually the good news is there's actually federal funding available. But the challenge from a collaboration perspective is determining which projects do we think should get the funding, and then which project matches the best federal fund source. I mean, there's some, I think, over 10, maybe 12 different potential sources of federal funding. And so there's also this process of matching the projects to the right federal funding source, basically. And our software can help with every dimension of everything I just went through, from running campaigns to acquire project proposals and project ideas, where the project website is basically being used to collect ideas and take those then into a screening and filtering and review process where you can have organizations collaborating on that and using data and using scores all the way through to then taking those projects to the funding source and saying, look, here's the set of projects that we think best match this funding source, which could be, federal Department of Transportation funds, could be state funds, or they could be one of the mechanisms that Lawrence was describing, such as a cat bond, or that Michelle was describing, basically. So that's a very, very quick overview of the Texas P3 Resilience Marketplace that we have in place. And we're basically preparing to start a pilot and start a phase of where the different agencies are able to use it and evaluate using the software and understand what that means and so forth. And so we're definitely interested in bringing on anybody who's interested, any of the agencies who would like to kind of kick the tires on the software and kick the tires on being able to use the software to help with the different processes of collaboration and determining which projects should receive funding.
So Mike, let me, because I know we're going to push the envelope here of having folks a little bit longer than we expected, but let me serve as the bridge. I think one of the elements that you've explained to me and shared with me, when we start talking about rankings, a lot of projects in a lot of the funding mechanisms already have certain rankings built in. Could be the cost benefit, could be, I think what ties into part of this conversation is that while certain projects are in the rankings tied to public funding, one of the other opportunities is to identify what a private sector source of funds is also looking at in the way of rankings. And that gets Lawrence to the opportunity to take the assessment tools that RMS uses, right? And be able to say, will this meet the requirement that an insurer or an investor would want to take? And you use that as the profile, whether it's a large real estate asset holder, developer. So I think for the purposes of beginning to wrap up, my takeaway from today's conversation is we now, and Michelle, you've qualified this. We now have a lot more data than we ever had before, all right? And as a result of that, we've, had the opportunity to see more and more data unfold from FEMA, from the private insurance arena, in academic sources. I think that data is in a position now to help qualify and quantify public-private partnerships, return on their investment. And that return on investment is everything from financial, societal, environmental. And so I think, my hope is today is one more piece of information for public entities, private entities, consultants, engineers, advisors, to really take a look at how all of this data can be brought together, and where the insurance industry is already, as Michelle said, already has tools that could be applied here. I don't want to speak out of turn, but Michelle, as of about an hour ago, Aon announced to the Texas Water Conservation Association, which is primarily water utilities, but especially rural water utilities, they have announced a new product dealing with drought mitigation and the gap financing for doing public-private partnerships. One of the next things that we've been talking with Aon about is how to take this to the other extreme, and that is too much water. So I believe that we have an opportunity, not only in Texas, but frankly across the United States, to leverage these kinds of data tools, the opportunity to bring insurance to the table in some new ways, even though that, frankly, some of these are existing tools, and then to use something like the marketplace as a means of bringing and accelerating, so to speak, a transaction. So with that, any other quick comments or observations before we let people have their time back? Anybody?
I think you're right, though, Richard, about the combination of all these things coming together. I mean, the bad news is there's a lot we have to do for the resilience. The good news is there's many, many, many things at our disposal and many things
Right.
coming together. We just have to use them effectively and
Exactly.
and collaborate.
Well, with that, thank you, Michelle. Thank you, Lawrence. We've recorded the session. We've got your presentations, and I look forward to following up with the participants that were able to join us today, as well as folks that were not able to join us but have wanted to participate. Michelle, looked like you had one more comment.
Yes, Lawrence, should we be wishing you happy birthday? Because I just noted that it says 30 in quarantine behind you.
Oh, yeah, that was a couple of weeks ago. Still haven't taken it away.
Happy birthday.
Thank you.
We all remember being young once. Right. Thank you all for your time.
Bye-bye, everyone.
Thank
Take care.
you. Bye.